Welcome to S&P Global Market Intelligence G7 Oil Price Cap. Just a quick introduction on our panel. I'm Robert Perkins, journalist and editor at S&P Global Commodity Insights, covering the news side of the Russian sanctions and EU sanctions on Russia. Fotios Katsoulas, the principal research analyst at S&P Global Commodity Insights, who will be digging into the trade flows issues and tanker fleet implications of the price cap. Lilith Gevorgan, Director of Economics and Country Risk, giving us the macro Russian picture and implications for the ruble. And Byron McKinney, who will be kicking things off with a little overview of some of the detail around the price cap itself and the legal wrinkles that it involves. So, Byron, let's come to you first. We said already that it was an extremely complicated piece of policy that the G7 had really sat down together with and had to hammer out the details for months, really, with EU leaders and G7 members. And during that time, there's been a number of releases of little updates and snippets of information that sort of slowly build the picture of how the price cap is going to work. So talk us through, Byron, what are the main parameters of the price cap and some of the wrinkles that the industry may or may not be familiar with yet.
Thanks, Robert. Thanks for the introduction. Briefly set the scene really around what the price cap is, who it affects within the supply chain, and some of the nuances and subtleties around it. So there have been a number of Q&As over the last couple of weeks, slightly before the price cap figure was provided to us and was announced at the $60 barrel mark. So all firms and organizations within the supply chain world, fall into three tiers. And these three tiers are basically applicable from the three kind of key authorities within the price cap mechanism. So the European Union, the US, and the UK as well. There are some slight differences, but not major ones. So in terms of the tiers itself, tier one is where you find the commodity brokers, the traders, and other firms which are, kind of directly related to the actual buying and selling of oil, and Russian oil in this particular example. So these will be firms and organizations which, as part of their day-to-day activity, will have access or potentially have access to the price information. Those organizations which are in the tier one space are expected to then share that information with those further down the tiers. So tier twos, which cover financial institutions and ship agents, ship charterers, etc. And then into the tier three space where we find the insurance companies and the P&I clubs. The kind of key things to remember, especially around the tier one area, is that, whilst this kind of looks fairly easy to implement in terms of the theoretical side of it, in terms of how brokers and traders determine the price of oil at a particular time isn't always as straightforward as it's kind of made out in the kind of Q&A, which was released by the EU and the US as well. Obviously, some oil trading kind of takes place using particular benchmarks against other oil trades. So it's not always kind of known, that well in advance, what the actual price of a Russian oil cargo is likely to be. So there's some kind of issues which, could play out over time in terms of, how well known it is the actual price is actually determined. In that documentation, which those commodity brokers and traders have, as I mentioned, they're then meant to share that lower down the chain. So to the banks, the charterers of vessels, they will then be able to kind of see documents and information from the brokers and traders to be able to determine, what is the actual price of the barrel of oil. And it's worth remembering as well that the price cap is based on the price of the oil as well. It's not based on any of the associated ancillary services which are attached to the trading of oil. So any insurance cost, freight cost, that is not included. That is separate and outside of the price cap. That $60 barrel value, that price, that is just for the oil itself. So as you kind of go down through these tiers, that information needs to be kind of broken out in certain ways. So for particular information purposes for the financial institution, there needs to generally be an itemization, within the bill of lading or whatever the actual trade transaction document is passed down the tiers. How that price is actually broken down. Is it the price of the oil, or does it include other potential services which are attached to it as well? Further along there, in terms of record keeping as well, The kind of key requirement from all the authorities within the G7, EU, US, and UK is around having that documentation available and needing to be retained over certain periods of time. So in the UK, 4 years, EU and US, it's over 5 years. That information has to be kept and has to be used by those firms within these tier classifications. If the documentation isn't available, then those in tier 2 and tier 3 can rely on attestation in terms of information, which they can take from tier 1 in terms of the broker, the trader, or the buyer or seller, to ensure that they have applied and they are working within the confines of the actual price cap itself. So that kind of gives a very high level basic run through of the reporting requirements and how those tiers are kind of balanced. Elsewhere, it's kind of worth noting as well that there has been a prohibition on the shipment of Russian oil from Russia into the European Union and to the US as well for some time. So an executive order which was released in the US, and also I think in the sixth package of trade sanctions from the EU in June, had that prohibition. That prohibition is still in place. So that doesn't change with the oil price cap. The oil price cap is there to kind of look after oil trading, which is outside of those particular jurisdictions, or jurisdictions which have operators within them, which are likely to be involved with the shipment or trading of Russian oil. But there's no change in terms of, how that framework is put together. So there's two kind of, major pieces there as well. So, for example, EU operator or EU firm who wants to trade with Russian oil has to do so with a third country outside of the EU and has to be done within the oil price cap. That can still kind of go ahead. That's all still fine. That isn't prohibited under the sixth package of the EU deal.
Thanks, Byron. Yeah, that's a nice dig into some of the detail there. We're going to go to Fotios. A lot of interest has been around at $60 a barrel, the price cap which has been set for Russian crude. Most people have rightly noted that the key Urals grade, the main grade for exports that used to head to Europe at least, is trading well below that. Thereby, are the price caps on crude having any impact at all? And I think that's something that the market is interested to hear about.
Great. Hi, this is Fotios. Atsoulas. So thank you for the question. I think it's very clear that even though we have seen deals below the price cap of $60 already, especially the levels have been already significantly down in November, it is clear that we have a very big shift in terms of the direction of the cargoes. So this is what we will look closely in short time. So there is no doubt that the enforcement of this ban could add severe pressure against Russia. So it could take a rather big portion of its crude exports off the market in early 2023, which would eventually drive a rally in oil prices. The current price cap is not expected to have a dramatic impact in terms of Russia's finances, assuming that it would be possible to secure the required insurance. And of course, since the prices that these barrels have been sold have already reached levels below these levels. Focusing on Russian Urals, we have already seen substantial discounts versus Brent, so below 60 barrels already in November, which has happened for the first time in months, as the market is also affected by expectations on weaker global demand due to the situation with COVID-19 in China. However, the current cap is strong enough to prevent Moscow from profiting if oil prices start significantly recovering. So that is the biggest aim, the biggest target of the EU. Of course, there is also the scenario of the EU further lowering the cap in future to further increase the pressure on Russia. So some of the countries have been already asking for lower caps. An example has been countries like Poland. They have been suggesting a lower cap of up to $30, for example, so below the cost of production for Russia. This would only allow Russia to keep selling oil to simply avoid having to cap wells, because otherwise they could not easily be restarted. Asian buyers, primarily China and India, are understood to maybe not go along with a cap. So both Russia and China have already been moving fast to quickly set up their own insurance providers that would allow them to continue their trading oil.
Thank you, Fotios, for those insights. Let's move to Lilith. Lilith, I mean, the target of the price cap is to hurt the Russian economy, to dent its ability to wage war in Ukraine through its state revenues. Tell us, is it working, and will it work or not?
Well, there are two parts to this story. A more concrete question is that will these sanctions prevent Russian military spending or have an impact on its military spending via impacting the public finances? And more broader question, whether sanctions are working at all. Actually, are they hindering Russia's appetite in Ukraine, Russia's aggression in Ukraine? So I'll start with the last question, and I will say that the sanctions are working. And I'm saying this despite the Russian authorities claiming that their economy is relatively resilient and they are doing a lot better than expected. In fact, the Russian finance ministry, right at the start of the war, was expecting about 15% decline in real GDP under the worst case scenario. But the latest data points are suggesting that the real GDP is likely to decline by under 4% this year. However, there are issues that I want to highlight in this regard. Since the start of the war, Russia has restricted access to some of its important data points, including external trade, budgetary expenditure, air travel, and so forth. Therefore, I would say that data availability and accuracy remains an issue. For example, over 1,500 foreign companies have left the country since the start of the war, and many more Russian companies have left the country. However, the recent statistics suggest that Russia has the lowest unemployment rate since the collapse of the Soviet Union 30 years ago. So these are just to give you a flavor of what we have to work with to gauge the impact of the sanctions on Russian economy. Nonetheless, the Western sanctions have been unprecedented in terms of their speed and scale, and also they've been unprecedented in the sense that a large economy like Russia, a critical source for hydrocarbon and other commodities, relatively well integrated in global commodity supply chains, have been targeted by these sanctions. What we saw initially in February, March, was a strong shockwave that went through Russian economy, mostly sort of the financial system, and that was because the ruble lost 50% of its external value against the dollar. And one of the reasons why this happened also is because above 60% of Russia's strategic currency reserves were held at the time in G7 countries have been frozen, and most likely they will be used in the future for Ukraine's reconstruction. So this also had a significant negative impact. And of course, Russia, for the first time in 100 years, defaulted on its external debt. So since then, arguably, the situation has stabilized. And this is why the Russian authorities present its sanctions as not that important and not really working. However, the reason why the situation has stabilized is because of the bandages that Russia's monetary authorities have used. Now, these bandages are they're not sustainable. You cannot use it for a long time. And by bandages, I mean measures like strict capital controls, the hold of rubles, trade against the US dollar and euro. Now, we assume that the sanctions are here to stay for the years to come. And as a result, Russian economic outlook is even weaker than prior to the war. In the near term, Russian real GDP is expected to contract cumulatively by 7.5% in 2022 and 23. And this compares to our pre-war forecast of cumulative growth of about 6%. We think that Russian economy is going to see permanent losses in level terms. On average, in the long term, the economy is expected to grow by a meager 1.3% compared to 1.6%, which was already quite weak. Just to give you a context, Russia needs on average 3 to 4% annual average growth to progress economically. So there are three reasons why these output losses will happen, and they are again linked to sanctions. First of all is declining investment. The current G7 sanctions regime is specifically targeting or banning investment in Russia's strategically important sectors, energy, metals particularly, And we do not think that China, for example, will be able to replace Western investment that have been in Russia for the past 3 decades. Second, we expect that Russia's infrastructure will be deteriorating faster because of the poor private and public investment. And lastly, we think that a crippling impact will come from population losses. According to various estimates, between 1 to 4 million Russians have left the country since the war started to avoid sanctions, and in September to avoid partial military mobilization. Many of these immigrants are likely to come back, but many more are likely to stay in their host countries. Now, the declining finances also imply less investment in social and healthcare programs, which will add to population losses. Now, the impact of the sanctions on Russian fiscal revenues, they have been less dramatic, according to available data. One of the reasons is because several G7 sanctions were implemented with delay to mitigate the negative fallout specifically for Eurozone countries. In addition, high market energy prices have also helped Russia to somewhat offset the drag on the budget revenues from shrinking non-oil and gas revenues. So despite the high oil prices and delayed implementation of sanctions, we still believe that, or forecast that, fiscal budget deficit will be about 2.1% of GDP in 2022, and this gap will widen to 3.9% of GDP next year. And this is in part because of the crude oil price cap, but also it reflects this negative or deteriorating softening commodity prices due to recessionary conditions in Eurozone particularly. So what will be the impact of the current price cap? And what is the impact on Russian finances? And will this have an impact on its ability to finance war? I'd say at the moment the impact will be limited. Since the war started, Russian Urals crude has been trading at around or below the $60 per barrel mark anyway. This is due to heavy discounts of around $20 to $35 per barrel. Another factor to consider is declining share of oil and gas receipts, a share of total revenues. It has been declining from 50% in 2014 to 35% in 2021. Ironically, as Russia has been consistently moving to lessen its dependence on energy sector generated revenues, now it implies that Russia's fiscal position will be weaker because it is the non-oil and gas sector revenues that are falling faster compared to oil and gas revenues. And the non-oil and gas sector revenues are falling precisely because of the negative impact of G7 sanctions. So at the moment, prices which Ural blend is sold remain above the budgeted break-even price of $44 per barrel for 2022 and $45 per barrel for next year. In terms of the production break-even prices, the estimate hovers around $40-45 per barrel. So considering these data points, a new price cap of around $35 and below is what you'd need to trigger a notable shock for Russian economy, its public finances, and its ability to finance war in Ukraine.
Thank you, Lilith. That's really a great detail there on the implications for the Russian economy. We're going to go back to Byron now. As a market participant, we can value the importance of maritime intelligence with real-time ship monitoring, tracking capabilities for ship-to-ship transfer and voyage irregularities such as dark vessel data. There's been a lot of press coverage around this issue of shadow tanker fleet, dark activity. Does that simply mean then that with current tracking tools available, there is no way at all of tracking those volumes? They can go completely under the radar? Or are there certain ways that the market can get a sense of the circumvention levels of Russian barrels?
Yeah, so in any vessel which does potentially go dark or in real time go dark doesn't necessarily mean it can't be tracked and you can't trace the movement. There are kind of ways of pulling out the information to see where the vessel is. And most kind of service providers who offer that kind of tracking facility, have various models and algorithms in place which allow the vessel to be kind of identified, when it first drops its signal and then when it comes back on. That kind of time in between is when, the most sophisticated and models and algorithms out there are able to kind of generate various scenarios as to where the vessel might have been able to call, or where, if there was another vessel which it was able to pair with and then transfer cargo from one to the other. So yeah, the dark mode is fairly important in this particular context because it is called out in certain regulatory documents which people from various organizations and firms within financial institutions, insurance companies, shipping firms and others need to be aware of and need to account for as well as part of their compliance screening programs. It is challenging. And as we've seen, with the potential for Russian STS activity to now be likely to occur outside of established zones and a long way from Russia as well, it becomes even more tricky to be able to manage, but can still be done, with the right algorithms, the right models, it is all possible.
Yeah, I think there's a lot of discussion about that. Lily, you said that you think it'll be a multi-year issue for Russia in terms of the economy. If and when Russia decides to wind down, pull out, give up its war in Ukraine, is there a simple sort of exit strategy from price caps? Is it a question of just the G7 saying, great, that's it, we can lift them now, everything goes back to normal? Or would we expect to see a transition period, or perhaps the G7 or the US using certain parts of the cap as, or retaining them as some kind of carrot and stick for greater compliance for Russia in the future? Any thoughts?
Well, specifically about the price cap and the direction it's going to move, as long as there is the invasion is happening and the war is happening, I don't think that we will see, there will be one direction and there will be towards reducing that price cap. Ultimately, the price cap is somewhat a mitigating factor. The sanctions are the disruptive measure that the G7 countries have taken, and the price cap is sort of a mitigating factor to allow some of that Russian oil still being sold. But as the overall oil prices are showing softness, I think that we will also see some of the price cap being revisited. If I'm not mistaken, it's due for revision in 2 months' time. But overall, the sanctions, our baseline assumption is that they are going to stay because we don't think that there will be any significant domestic changes within Russia. The only scenario, which is an optimistic scenario, is probably about 20% likelihood, is that you have a change of government, but in this case, a government that is ready to reset relationship with the West. And then you can revisit the sanctions, especially on more sensitive commodities, or come up with a regime of withdrawing them. There's also another side to this story that really, because of this, the war, because of the sanctions, Russia is in the process of losing one of the most important, if not the most important customer, to the Eurozone, which coincides with Eurozone's own ambitions of diversifying of its energy inputs, first of all, and secondly, moving to more sustainable energy. So the war in Ukraine has only helped in some ways Eurozone to accelerate those processes. And even if there were no sanctions or war in Ukraine, in the medium to long term, the changes that Eurozone has been pursuing would have had an impact on Russian economy and energy sector anyway. So I think that in the long term, because of the combination of sanctions and these changes in Eurozone countries, we will see negative impact for the Russian economy. But the price cap, to go back to your question, will be probably reviewed in lockstep with other sanctions against Russia.
Great, thank you, Lilith. It just leads me to first of all thank our presenters today, Lilith, Byron, and Fotios, for their fantastic insights into the impact and implications of the G7 oil price cap. More to come, obviously. We have, as mentioned, the price cap extending to oil products from Russia from the 5th of February. We'll be tracking those on the news, and we'll be doing, obviously, extending that to oil products when things start in February for affecting those flows. With that, thank you to everyone for participating, and thank you for our presenters. Have a great afternoon.